All right. Good afternoon, everyone. It's Sunday here for the Swami Weekly Wrap. I have myself, Brent Willie, and Turtle Capital here to talk a little bit about the update. We are live streaming this at the same time here. So trying something new for the Swami Weekly Wrap. So, hey, Turtle, how are you doing?
Excellent. Happy Sunday, Brent. Good to see you. It's been a couple weeks since we did a live video recording, and
Has been, yeah. We've been up to some new stuff that's coming out soon. We're working on, and then the holidays. But yeah, excited to catch up because man, the market has just been wild. It's been wild and a roller coaster. And I'm excited to just let's dive into this and talk about it because I think there's some interesting points that we got from you, from Joe, some of our other colleagues out there. So let's dive in. So why don't we talk a little bit about the Swami Dynamic portfolio performance?
Yeah, so we've been positioned very defensively, even coming into the back part of this year. Risk assets really bounced in early November, and then that bounce has obviously faded here in the last couple of weeks. Last week, on a week-over-week basis, the S&P was down 2.6%, and then 60/40 was down about 1%, and then we were down less than 0.5%. So good week for us. We have a 100 basis point lead on the benchmark, which is AOR, the 60/40 portfolio from iShares, and we've got a bigger lead than that, about 4.5% on the S&P. What's interesting is that, and that's the model portfolio, which we'll show you here at the end. So what's interesting is two things, Brent. I thought that some of the divergences in performance, right? So on a week-over-week basis, second week in a row, yields down, tech up, right? That's the narrative. However, that narrative, as we've kind of been talking about, you're seeing the bifurcation in performance between tech and long-term treasuries. Long-term treasury bonds and technology stocks, especially profitless ones, it's a big difference, right? Even though mega cap tech was actually a lot of the problem this last week. So especially one more call out from this slide I'll bring to your guys' attention is on a 1 month basis, right? So if you look at the last 4 weeks, what's interesting is that you really see the divergence there, right? So EDV, which is the longest term treasury bonds, up 9.5%, and MGK down almost 5%, right? So again, just point being, we're seeing divergences. We're overweight long-term treasuries, we're underweight tech, we're underweight higher beta ETFs or higher beta equities. And so anyway, that's been interesting, and we've outperformed really here the last couple of weeks. What do you think about all that?
It's interesting to see those bonds finally coming back. So, and it's just a weird situation where up is down and down is up with, the Fed wants to raise rates. We still have inflation, but then they don't want them to cut. And it's so hard to play. It's like they cut, but they didn't cut enough. So, man, it's confusing out there. But if we stick to our signal and our process, I think the signal is especially helpful during, and some of the Swami scores here are going to help us along the way. So I think using our instruments, it's kind of like flying in the fog. You got to use your instruments when you can't necessarily see everything that's going on. That's the analogy I think is appropriate here. But why don't we talk about the portfolio composition, and then we'll keep moving along.
Yeah, that's a beautiful analogy. What I would say about one thing I'd add to that, and then look at portfolio composition, is that what's very interesting is that because what we're looking at and what we're going to show you here more on is specifically exchange data, right? These are ETFs. These are stuff that securities people are buying and selling, right? Not survey data, not economic barometers, which are backwards looking, right? We're looking at real-time market prices and the volatility of those market prices. And so, with that, Brent, the portfolio composition in general, we're still positioned very defensively from a high level, where core of the portfolio is cash, right? Or not strictly cash, but GLD, if you count that as cash. FXF is Swiss franc, That was positive last week. Not much wasn't positive by much, but it was positive. UUP is dollars versus other exchange traded currencies, or dollars versus other currencies. That's an ETF you can buy that puts that exposure on for you. That if you include that with cash, that's a quarter of the portfolio. Equities are now 44% of the portfolio. We took that up about 6% last week. We bought, so the top three exposures within equities are VIG, VIGI, which is VIG is Vanguard Dividend Growth. Talk more about it, but VIGI is International Dividend Growth. So these are dividend aristocrats or companies that have a long history of raising dividends, but these are international companies, right? So not based in the United States. And then lastly, healthcare, which we took to a full position last week, is also one of our biggest equity exposures. Within fixed income, we're all treasury bonds. And then within sectors, so you get kind of the flavor of what type of equities we own. We're underweight tech, underweight consumer discretionary, and underweight financials. Altogether, beta is about 0.3 for the portfolio.
Good. Yeah. And we raised it slightly with some purchases last week, if you guys saw that email update.
That's right.
So market dashboard wise, I'll let you summarize this a little bit. I just want to talk about one part, and this is kind of related towards our like kind of stoplight or kind of like our macro backdrop here. And the biggest thing that I'd say that stands out here has been the US dollar losing a little bit of its signal here. So that is definitely going to be something significant that we're paying attention to. We're not ready to write off the dollar yet. We reduce some of the position size because we do have to respect the signal, and we could reduce the position size more, but we want to see what it does. And that dollar is going to be definitely significant, is the number one thing I want to call out.
Yeah, great call out. And in the last couple, the last couple weeks have been actually really a month and a half. We've been calling this out that the signal's been weakening. Clearly, the dollar's been a wrecking ball for most of the year. But yeah, clearly the signal has been weakening. And as we've been talking about that, this gives dollar weakness gives breathing room to all risk assets, commodities especially. Things that are negatively correlated to the dollar, gold, which has really looked a lot more constructive. And to Brent's point, the last thing I would add to that is that we do sell a 5% position in the dollar because, or in UUP, right, which was our biggest holding. That was like, a huge percentage, 18% we took it up to, because it still has such a negative correlation to everything else, right? So having some exposure, like Brent said, it's hard to really write it off because a lot of the fundamental factors that got us into this predicament are still there. So that's just on that. Aside from that, Brent, don't have a ton. I guess, industrial metals, right, look good. More on that. International equities, right? We did add to VIGI, so international equities. If you're going to buy international equities, not necessarily, you don't want to buy VIEs like based in the Bahamas that supposedly give you some interest in some Chinese stock. Rather, you want to, we think you want to have an exposure to stuff that's more of a cash flow generative enterprise that passes along dividends for many years and raises them. The last thing I'll say is, Bitcoin's still got a positive score, just barely hanging in there. Volatility has picked up a lot in cryptocurrency land, but Bitcoin itself still, again, it's not in the model portfolio. We're not recommending you buy it, but it's just an interesting call out, I thought, quantitatively.
Yeah, you definitely see people. I think this time, like there are some people now that came back into the market, at least said, "Hey, I want to buy in, try to buy this bottom." It's interesting to see that I think a lot of those people chose not to buy into high they tended to buy low beta rather than high beta, bought value, right, bought dividend, right? So that's the thing. People may be hedging themselves a little bit and more moving towards quality. They're not buying story name stocks, meme stocks, small caps, all those sorts of things. So that is an interesting behavioral response, I think, that we're seeing from this. And the setup that I've been talking about I think would suggest, hey, end of the year, people may be looking to chase. They've been getting eviscerated. Let's see if we can boost our year end to get that, maybe that bonus or whatever we want to do, that behavioral that function. Okay, let's get it, push it, maybe get a Christmas rally, and then the rug gets pulled on us in beginning of the year, end of the year. We've seen it before. I think 2018 saw a similar experience. So those are just some things that, obviously, I don't want to just tell stories like this and be too narrative-y, but those are some ideas and setups that I may be seeing. That's like, I'm kind of like smelling out there.
Yeah, and I think that's a strong case to be made, though. And so, yeah, we'll see what happens. But no, I like that. I think it's a fair hypothesis for sure. But to your point, this week on Friday, SPY broke trend, SPLV, healthcare, we'll show you more. Some of these defective, safer chicken longs, sometimes people call them, the more defensive ways to be long equity, but to be long Johnson & Johnson is not the same thing as Carvana. The signal has been favoring these more defensive names. And guess what? They didn't break trend. They're still bullish trend, while SPY is bearish trend. On this slide here, commodities, cryptocurrencies, and commodities, crypto, and currencies. What pops out to you, Brant?
I mean, it's the precious metals and some of the industrials for sure. And it's funny that it's the commodities they're kind of like, it used to be energy as the commodity was up at the top king, and now seems like those have fallen off and the dollar's fallen off a little bit, but you still see that, like, okay, cocoa's still there trending, platinum, soybeans, silver, gold. I think there is a case where Turtle and I were talking, silver could make an appearance in the portfolio, mainly because we have a lot of gold in our portfolio. It's been ripping, so it's been really strong for us. But I think there's the industrial use case of silver that also has the precious metal element to it. Might be things to consider looking at.
Absolutely, and those are good call outs. A lot of this is the inverse of the dollar, right? So that's a good call out. These are some notes in the top corner from Joe. As he says, the dollar remains in a downtrend. That really makes a lot of commodities, more viable for sure. Another thing that I think is interesting to think about really quick is, like, especially on Twitter Spaces or something, a lot of people talk about, they start everything with an assumption. So since we're in an inflationary regime, since the dollar is we're going into a period of dollar weakness, or we're going into a period of dollar strength, making assumptions, et cetera, makes what think about, look at how counter narrative a lot of these scores are, right? So Great British Pound, right? Remember recently that was an emerging market currency. All of a sudden that's your second highest score, right? Remember, speaking of emerging market currencies, those look very good, actually. And again, the dollar, right, is something that no longer looks good at all. And remember, that's been the story that if you just read the news, that it'd be hard to wrap your head around that, maybe.
Yeah, a lot of these still have great upsides too, compared to downsides in terms of the trim and ad levels. So definitely want to consider that for some of these new bullish trends.
Yeah, and DBB, that trend line of 1280, if it can hold above that next week, that's very constructive for industrial metals.
Yeah, so moving along here, bonds making a little bit of a comeback. So munis may be something to consider that we haven't dove into yet. Certainly we're loaded up to the teeth in terms of TLT, EDV, all those. But yeah, that would be some things to call out. Finally, we're getting some life out of the treasury market.
Yeah, and I think absolutely. I think there's a lot of position to move more once all this stuff really flips. We were too early on some of it, and we've been there for what could end up being the turn. But once once it becomes more clear that this is going to be a turn, and especially if this starts trending the other opposite direction, there's going to be a lot of money to be made. For the first time in years, bonds offer yield. That was, that's you wake up a 2018 investor, and show them what's available to them now. I think a lot of them will be very interested in fixed income. SHV, SHY, these short-term treasury bonds, that's interesting to watch. Once that flips, that's almost purely a function of the Fed policy, right? So watching that, watching long duration, the curve is very inverted, that's another something. It's also something to watch.
Good call out on the curve. Factors wise, SPY's breaking, uptrend, low beta is not. So like I said, like where's the relative strength, right, in the sectors? What are people gravitating towards right now? What may they be chasing? Well, they're not chasing with those story stocks. So that'd be something to call out. IWM, small caps, Russell, those ones are not looking like Qs. Those are down at the bottom. Terrible performance this year. And SPLV is our king up there.
Yeah, exactly. And aside from RSP, right, which equal weight, that's kind of the one thing that doesn't look like the other ducks, but everything else, it's clearly this is the defensive chicken longs. That's what's still working, or that's what's still bullish trend, and that's what looks better quantitatively according to the Swami score.
Sectors. We were on factors. I think I said sectors earlier. Interesting one on this one though. GDX. So gold has been ripping the miners. So I could see if the miners could make they can rip your face off sometimes, but miners will if energy costs and stuff like that come down, maybe rates start to hint at coming down and gold starts to rip. That's really what the miners need in order to be beneficial for them. So we'll see. Maybe it's on the maybe short list. Signal looks good. I just know the vol of GDX can be very slippery and hard to tame.
Right. The other one that's interesting, like we've been saying again, so clearly the defensive sectors, those look good. So that's XLV, XLP, XLU. The other, XLRE historically sometimes is a defensive sector. It does not look great here, right? Still bearish trend. Still bearish trend. The home builders though are look better than REITs in general. The home builders trade more of a function of interest rates, long duration interest rates, and mortgage rates. So what's that? Is the market sniffing something out there, right? It's something to watch. I don't know, but is that and mortgage rates come back to there's gravity in the mortgage market or in the mortgage rate market. These are things to watch.
Yeah, I don't have any other call outs on this. I would just say again to everybody, like, it may make sense to dive in and try to get to swing at a couple of these, but I wouldn't dive in all the way. I would put maybe your toe in or your leg in, and before you just full on dive into some of these new trends, because again, like, things are still correlating together, and that low beta has saved our ass this year for sure.
Yeah, and keep going, it's fine. But no, you're good. Well, the divergence there, so XLE versus XOP, right? So XLE still holding trend for now, but first the commodity loss trend, then the the more speculative names, then the last to hold on is the more your Chevrons, Exxons, the more because so anyway, so that's that.
But again, those benefit those at Chevron and those are more blue chip. They're going to be lower vol, pay dividends usually. I mean, so yeah, but the speculative of XOP for sure. Some of those oil and gas companies, I'm sure, are going to have a lot of trouble next year.
Right. Well, especially if commodity prices keep going down.
Yeah. What's price of gas is looking like it's dropping. So macro stoplight wise, to summarize this, the key reason of why green, and we're reckoning, we bought some beta last week. We had to acknowledge this green stoplight, and so far it's been so good. Interesting though, its main reasons for this is vol has dropped below trend. We've seen vol see that before, and it has not officially, VIX for instance has not dropped below 20. You really want to see this thing below trend and below 20 for us to pile in and get into maybe tech, large cap tech, all those names. It's one of the major components. And the other reason is the dollar has started to roll over, right? And that has boosted, kept commodities up and the dollar down. Now we do have an odd situation where gold is ripping now, and then also yields are starting to get some 1 month price momentum, or like TLT, EDV, all those ones you mentioned. So it's crazy out there now. VIX, VXN, some of those ones that are some of the components of our stoplight could influence this a lot, and it could cross back over quickly, but we do still have to acknowledge that green. And I think the changes that we made this week with going into those defensive names of like XLP, XLU, XLV, some of those other additions were us acknowledging, saying, hey, we still continue to be bearish in bias, but we have to be careful and not be overly bearish, because you have to acknowledge the trends that are right here in front of us. Use our instruments, as I said, like flying in the fog, right? You use those to land the plane or navigate, not run into a mountain. If you can't see, you got to rely on your instruments. So that's what I would say is the latest with like the macro stoplight here.
Yeah, no, I think that's well said, Brandon. The again, back to what we were talking about a little bit earlier, where we're looking at market prices. This moves faster than economic some government bureaus CPI data, right? This is going to be a faster moving, because this is market prices from Friday and Thursday and Wednesday, et cetera. So that's but with that said, it still is backwards looking, right? So again, it's still from the previous market day. So clearly the where we just, and I guess what I'm trying to say is, like, it's interesting because I think I spent a lot of time on Twitter, and people have to they have to be bulls or bears, and we don't really ascribe to having to worship any animal deity, which is we're just trying to make money here. And
no human, no animal sacrifices here, but
right.
Who knows?
The markets, yeah, we do definitely acknowledge that sure, there are definitely some great cases to be made about storm clouds gathering in certain places. Clearly, cryptocurrency, right, which was a position in this portfolio, not that, not more, less than a year ago. A very small position, and one that we risk manage very well. However, it's something we definitely look at, and so there's clearly risk brewing. We'll definitely acknowledge that, but the macro stoplight is what it is, and we, like Brent said, we're looking to buy great bullish trends when there's dips in them. So enough. What do you think, Brent? What else?
No, I think I covered it. So I think we're reacting and reading. So it's hard out there, especially for your maybe intermediate to long-term investors here. It's tough. So yeah, I think that in summary for what we bought, VIGI, XLP, XLV, those were all those kind of more value, lower vol, lower beta items, and took down our cash a little bit, which is probably a good idea considering if consider your cash is denominated in US dollars, and the US dollar, took a hit. It's fine. We're not, but we did drop down the cash because we mainly wanted beta, not because we're completely bearish on the US dollar yet. Just wanted to clarify that.
For sure. And no, you're good. And the only other thing I'd say to that is that because the risk is, clearly there's multiple risks, right? There's a lot of risks, but one risk is getting left behind, right? So like Brent
exactly.
Before, kind of like the ultimate, the month end markup, right? There's quarter end markup, but this is year end, and especially, we talked about it with the CPI frame. We don't go all into it, but we talked about the CPI print being a river card, and Tuesday morning things were looking pretty good for the bulls, right? Until the market opened, and then I think peaked out about 30 minutes later, and then kind of there's selling pressure the rest of the week. But the point is that, right, you really saw the case there for ripping into the end of the year, and clearly it didn't happen. There wasn't the setup there for that to happen. However, you definitely, Tuesday morning, you could have made a very good case for it. So with that said, the one risk is getting left behind, and your client's now like, wow, what the hell? The S&P closed down 5 and you're down 20. So that's clearly the risk. We that's what we did last week was buy into the dip on Thursday, and so yeah, we got some decent pricing.
Yeah. So then we have earnings, Nike, FTX, JS earnings next week. I think FedEx is obviously a big one. The general trend of FedEx can almost kind of be the canary in the coal mine, right? If FedEx is having issues, I mean, they literally have their fingers on the pulse of the economy with stuff shipping around and prices and who's moving what. They know a lot about what's going on. So I'd be interesting to see how FedEx is reporting earnings and talks about their forward-looking outlook and stuff. So I think that'd be definitely an interesting one on my agenda.
Yeah, it's actually a bigger week than you would have thought, right?
Yeah,
like these the week of Christmas, like these reports.
Yeah, General Mills is a huge consumer staple. That's kind of a blue chip dividend payer, low vol option, low beta option there. So yeah, interesting to see. So we'll keep our eyes on those. And then portfolio wise, here's the updates. Nothing too crazy to call out here. We just do have a lot more green signals in here. I think better to talk about here would be what we might be putting on the chopping block, or at least reducing. I think we said XLRE may be a concern. It is in a downtrend. I mean, with everything getting lifted up and XLRE not going anywhere, that does tell you something. It is a relative game sometimes, right? So that's something we may reduce. And also, as we mentioned, the dollar UUP, but we already did reduce it once, so we'll see.
Yeah, that's well said. The one the clarification is that SHV is the only other. So that looking at this table, right? If you're looking at Swami score and the 1 week delta, or the week over week change. To me, like Brent called out, the two that stand out the most are UUP negative 53 and weakening, and XLRE, which is poor and weak and strengthening a little bit. XLRE, like Brent said, yeah, we probably are looking to lighten it up. That's one where, again, we thought it would work. The back test says it should work. You don't live in a back test, right? The back test is backwards looking. The UUP is, of course, has a lot of it's very special asset, right? It goes up when everything else goes down. So but like Brent said, well, but then last thing I was gonna say is SHV, that's just our proxy for cash. It's just like an accounting thing for the performance tracking software we're using. So that's why we hold that position, because otherwise short-term treasuries really have not looked attractive all year. So just to mention that. But yeah, Brent said it well. I mean, the signals have strengthened across the board, but we like where we're at. We're defensive. Basically, what you see here is you see defensive equities, you see treasury bonds, and you see our various forms of cash, which right now are Swiss franc, gold, some US dollars. So yeah, that's what's going on. What else?
No, I think you said it well. So I'd say stick to your inbox, look out for the emails from us. We'll probably be typing out some updates or may have some midweek changes we make here. But so far, the end of the year is starting to come our way significantly, had some divergence. But yeah, we want to keep pushing the wins. And yeah, man, that's all I have to say.
Cool, man. That sounds good. Thanks for listening to